to welcome everyone participating in today's webinar, COVID-19 Response for Individuals, Small Businesses, and Nonprofits. My name is Jackie Cardello, and I am the President and Managing Partner at GRF CPAs Advisors, formerly Gelman, Rosenberg, and Friedman, and I will be today's moderator. I would like to start off today with some quick housekeeping items and explain what you will need to do to earn your CPE credits. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. You will be asked to recall these words in order to receive credit. We will be giving the CPE words periodically throughout the broadcast, so please write down the CPE words when they are given and keep them until you receive your certificate. They will not be provided again. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. The slide deck and recording from today's webinar will be available for download at the link shown here. You will also receive a follow-up email with direct links. Technical support and CPE questions may be addressed to Nathan McElveen at nmcelveen@grfcpa.com. Today's learning objective is to provide attendees with a better understanding of the COVID-19 crisis as impacted individuals, small businesses, and nonprofit organizations, and to provide 1.5 CPE credits. I would like to start by introducing your presenters for today's webinar. Walter Dial, partner in tax with GRF CPAs Advisors. Richard LaCastro, also one of our partners and director of NP Tax. Kimberly Davis, Director of HR, Ian Schumann, Partner with Outsourced Accounting and Advisory Services, Troy Turner, Vice President, Partner and also Director of our Tax Department, Kashif Ali, Chief Technology Officer, and Dan Farrington, the Regional Managing Partner for Fisher Phillips. So in our agenda, we're going to be covering various different areas, and I would like to start off with just addressing leadership in a time of crisis. We're going to dive into this broad area in more detail as we go through the various topics. But essentially, one of the first things you want to do if you have not already done so is form a disaster response team. This can be anyone that your organization designates, board members, officers of the organization, executive committee members, but the idea is to have a point person or point people, and it's better with, I'd say, 2 or 3 minimum people, a team to sort of spread out the responsibility of keeping up with everything as it is rapidly changing in this environment. This team is designated as keeping on top of the changing rules, the legislation, your office procedures and operations, and meeting regularly, touch base daily if possible. Keep key leaders and staff informed. You want to communicate weekly at a minimum to make sure that all of your team and your employees understand what's going on, what procedures and resources are in place for them. We don't want to keep anyone in the dark because that creates a little bit of nervousness. Communicate with clients and customers weekly. You want to be careful not to overwhelm them, so we suggest weekly, because right now we're all getting inundated with emails from vendors and customers about COVID-19. Reboot. Now is the time to be open to new ideas and, in fact, encourage them from your team. It's time to take note of the way things work, take note of what current policies and procedures may not really be necessary moving forward. We've all kind of had to very quickly reinvent the way we're doing things. And it's a good time to sort of take inventory of what policies and procedures you have in place, what you can change moving forward. I think this is going to change the way we do things every day in our companies and our families and our communities. And it's a good time to learn new things. Be flexible and model this for your entire team. It's so important now that we're all flexible as things are changing so quickly, and make sure you communicate this to your team, that you expect there to be some hiccups here and there. You expect things to change at the last minute. Things will come up. People have kids at home, pets at home, things of that nature. We all need to be very flexible right now. and be tactical. Now is the time to be tactical and put immediate policies in place and answer questions. We can prepare for the long-term recovery plan later. So with that, we're going to start with our first presentation. I am going to turn this over to Kashif Ali for the cybersecurity risk section.
Thank you, Jackie, and good afternoon, everyone. Cybersecurity. Security is needed more than it ever needed before, especially in the times like these. Cyber criminals they would love to take advantage of us at the time when there's a national crisis, not just COVID-19, whether it's a financial meltdown or any natural disaster. The cyber criminals are waiting for those breaking news, and then they go after us. Each year, there is more of a digital issue than the physical issue. Cyber criminals know how to get money through cryptocurrency and other ways, so it's hard to track them. So things are getting very digital. It's getting very easy. So some of the things that you could do to minimize is anyone who asks you to pay anything is a scammer. By default, hands down, they're a scammer. Lately, there have been a lot of emails circulating how someone can help you get a loan faster, how someone can help you financially by arranging some sort of funds. Anybody who asks you that to pay them to do that is by default is a scammer. No one should ask you for your social security number, your bank account number, or your credit card number. If you have a question, call the bank directly. Nobody should be asking you for your social security number either through email or on the phone unless you call them directly, confirm. So to keep up with the coronavirus scams, I would recommend going directly to a website that keeps track of that. Don't just follow an email. Lately, there's been scams of people advertising how to protect yourself from coronavirus by eating. Maybe there's a herbal drink or something. I don't know, but it's not going to work. You need to follow the scams on the website. Go directly on the website. Don't follow these WhatsApp trails and text messages. So lately, you will notice that there are a lot of emails pretending to come from who. If you have something that you need to look up, go directly on their website. Do not just fall for an email that's been forwarded to you by someone, because half of the time these emails are by cyber criminals. They want you to click on a link, they want you to click on a file, they want you to open something up and type your credentials. Also, another thing you could do is pay attention to the emails from CDC. Keep in mind that the government emails or their websites ends with .gov. Anything else any website that claims to be from the government but has .net, .org, .com is more than likely fake. If you have a question, if you need to see something, go directly to their website. Don't just fall for an email. So with that, email security is very important. It's probably more important than someone calling you up asking for information, because we get so many emails that sometimes it's so hard to double check every single email. You can just click on an email and accidentally open a file and encrypt your computer with ransomware. So some of the things you could do is do not open an attachment from a sender that you do not know and you're not expecting that attachment. Do not click on a link from a sender that you do not know and you're not expecting an email from them. If you're in doubt, call that person. Pay attention to the email address. This goes back to the earlier comment regarding the government email address being .gov. Pay attention to the email address. For example, a hacker can simply fake a domain name. My email address is my first name and last name at grfcpa.com. They could create a domain that is grfcpaa.com, cpe.com. It's so hard to miss that because you're not paying attention to the detail, and they could fake that email address and ask you to have a wire transfer. So keep in mind that if your employees are listed on your main website, they are easier target because the email is legit, the name of the person is legit. So you want to pay attention to that. So if you do happen to open an email with an attachment and you open the email or you open the attachment and it asks you for username and password, do not enter it. The second you put your username and password, it's stolen. And to follow up comment on that is also keep your work password separate than your personal passwords. Because if your work email is hacked, you also given them password for your personal bank accounts and all the other sensitive information that you don't want anybody to have access. So keep those two things separate. When you're sending files, don't send it in plain email. Use a separate file transfer protocol type of service. ShareFile, Mimecast is another one we use. So I wouldn't recommend sending a sensitive document just through plain email. That's usually not a good idea. If you use it through ShareFile, if a hacker's got hold of your email, at least they can't open that file, the sensitive information that you just sent. Another thing you could do, this should automatically be implemented in your environment. You must have a password with a lowercase, uppercase, number, and a special character. I don't recommend the 8-character limit anymore. I think that you should think of phrase instead of a word, or your favorite song, and mix the numbers up, mix the characters, and have a very strong password. With that, there's a polling question.
Okay. Thank you very much, Kashif. I'm going to go to our first polling question. Has your IT department provided tools to be able to work remotely? So we'd like everyone to please answer that question. And while you're taking a moment to do that now, and while you're submitting your answers, I will provide our first CPE word. The first CPE word is digital. And again, if you are wanting to receive CPE credit, please jot this word down because you will need it at the end. The first word again is digital, D-I-G-I-T-A-L.
Okay, the answers are pretty good. For the 4% that have no, I would recommend contacting your IT department and coming up with a solution. Okay, so the next part here is not really security. It's more of knowledge that you should have around sensitive data, what you can do to protect yourself or your corporation. Number one is training. You must provide training, especially now with everyone working remotely. It is so easy to overlook small details. You should provide a training. One of the ones that we use here is Know Before. You can actually send a sample email to test everyone to see if who needs more training than someone else who is more well versed in technology. So I would recommend giving everyone a training. So you want to make sure that someone doesn't just accidentally click on the link, and while everyone is working remotely, you don't want your network to be compromised. And keep in mind that most data breaches happen because a user made a mistake. User opened up either an email, a link, or put their password in somewhere where they should not have. Use the password to secure documents. If you don't have a way to use a file transfer protocol to send encrypted documents, or using something like ShareFile, put a password on your document. If you're sending a tax return or W-2, you don't want to send that in a plain email. So if hacker or cyber criminal was able to get hold of your email, at least they are not going to be able to open that document. They have to work hard to get that document password de-breached so you can open the document. The next is for your IT department. They should patch the systems. I know it is very difficult to patch the system when you are not physically there in case something goes wrong. So at least pay attention to the security updates. Those are important. So have it tested somewhere else and then, make sure your systems are patched. You don't want to give cyber criminals an opportunity to get in your network and encrypt it in any way, because it would take days to come back online unless you have a disaster recovery that is robust. Next item I have is communication. If you have proper tools, working remotely becomes very easy. Some of the tools that I recommend are Amazon Chime. Zoom is another popular one right now. Amazon Chime and Zoom, they run on the same platform, same network, so the quality is about the same. GoToMeeting is another popular one. Microsoft Teams, Google Docs. Use these to collaborate, but keep in mind, as of yesterday morning, FBI released an alert that cyber criminals are able to hack into the virtual rooms. So you want to make sure that there's no fly on the wall in your virtual room. So count the number of users that are supposed to be in your meeting, and if you have something that's unusual, extra person in there or something like that, you need to address that accordingly. For your home, I would recommend that you set up a office like feel. So don't sit on the couch all day and work. It's not good for your health. It's not good for your back. It's just not good in general. Have a proper, think of proper chair, proper desk, and a keyboard and a mouse, and have that comfortable feel where you can work 8 hours without having to feel like your back hurts or you need to switch rooms. Have a quiet place. Try to make it feel like it's an office. Wire your computer if you can. If you can't, then Wi-Fi. If Wi-Fi is the second best option, then you don't have a choice. But try to wire your computer if you can. Keep in mind that home internet is not the same as the work internet. Home internet is shared by your entire neighborhood or your building, wherever you live. So work internet is dedicated throughput, so everybody is able to share that high speed that is guaranteed. Home internet depends on what time of the day you're logging in. Considering everyone is at home, it is pretty is in heavy usage right now. It's bottlenecked. Um, Kitchen may not be the best place to sit. You have interference from appliances. You got toaster, you got oven, you got microwave, you got all these other machines running in the kitchen that could interfere with your Wi-Fi connection. So if you're having a conference call, kitchen is definitely not a right place to sit. Other family members browsing, streaming can affect the speed. If you're in a conference call, video chat, you have kids that are children at home that are playing games, streaming Netflix and things of that nature. You want to maybe put a time on it. Have that at a later time or at night when you're not working. And then if your spouse is at home or someone else is also working, that's also going to affect your speed. Keep in mind you have Wi-Fi connection, that where you're sitting, or how far you're sitting from the modem or the router, and then other people streaming at your house can affect on your working abilities. So keep that to a minimum. And then, like I said earlier, everyone else in the area working from home is causing the stress to the system. So I would say that to keep the streaming after hours. With that being said, if you have any questions, just ask towards the end, and then I should be able to answer. With that, I'm going to turn it over to Kimberly Davis, our wonderful HR manager. Thank you.
Thanks, Kashif. Good day, all. The following are a few strategies and tips to keep in mind as you work with your coworkers remotely. You may also want to share some of these tips. Pretty much, working remotely can be lonely for some and truly overcrowded for others. Working from home was much easier when roommates, children, or elderly parents were at school, work, or in care during the day. But we now find ourselves in a situation where those living in a single residence, whether it's a studio apartment or a mansion, are home with each other 24 hours a day, 7 days a week. So, of course, this creates a slew of challenges. As Jackie mentioned earlier, you want to be flexible about your coworkers' needs and truly understanding of some of the background noises. Not to mention the surprise appearance of kids and pets on webcams all around the world during virtual meetings. People are trying to be productive in spite of the interruptions. However, Again, you want to be cognizant and empathetic to other situations. Dress as if you're in the office. You don't need to dress as formally as you might for work, but the simple act of changing clothes serves as a signal to yourself that it's time to wake up and get some things done. It helps draw the line between being at work and being at home. Prioritize your workload and keep a routine. Make daily to-do lists. When working from home, you have to hold yourself accountable. Keeping and working through a to-do list may, really help you stay on track throughout the day, and you truly feel like you accomplished something. Keep clearly defined working hours. You will get your best work done and be most ready to transition back to the office if you try to stick with your regular hours. Plus, if you're in a role that's collaborative, as most of us are, being on the same schedule as your coworkers makes everything much easier. And please do not extend your work hours because you aren't doing anything in the evening. Go find something to do. Put work away, recharge, and make time for your family and friends. If you live with other people, this separation is even more critical. Share tips and/or messages of inspiration. Truly, a kind word can go a long way, and we definitely need that now and again. Now, we move on to taking breaks. Go for a walk, please, keeping in mind social distancing. However, this does get you out to give you a little exercise and some fresh air. You want to meditate. It will help relieve anxiety and stress. 5 to 10 minutes a day can do wonders, and there are a slew of apps available for you to locate online. Use real-time media like FaceTime and Hangouts. You can communicate with coworkers, friends, and family. Take advantage of the technology that we have. You can always hear or smile through the phone, but to actually see it is even better yet. Hold virtual lunches. You can do the coffee breaks, happy hours, all of those things with coworkers. It's truly important to keep the, casual social interactions you're used to having throughout the day. If you usually ask your coworkers about their weekend, continue to do so. Send out a quick email, send them a text. These little interactions, again, another thing that goes a very long way. Reach out to individual staff members. If you would have spoken to your coworker face-to-face while in the office, why not give them a call instead of relying on email or text? Make an extra effort to stay personally connected with people so they don't feel disconnected and lonely. That's really a big challenge now working from home. Provide resources for your staff to address health and mental wellness. Most medical providers, such as CareFirst, Cigna, Kaiser, they offer televisits. Share information given by your healthcare companies that addresses how to seek care while at home. Utilize employee assistance programs. Remind your staff that you offer the service and provide the contact information. Calls to EAPs are actually up 20% over the last few weeks. The increasing uncertainty and anxiety about the financial and personal dangers from the epidemic can really take a toll on the mental health. Provide links to your staff about free workouts, cooking shows, games, and activities for families and children. They should try to fill their evenings and weekends with activities not related to work. Music artists and DJs are offering free live concerts from their homes. It's a perfect time to brush up on your dance moves and vocal skills. Free shows and movies are also available. Did you ever think about writing a book? In fact, your kids may also want to give it a try and include illustrations. You can then share your stories. Now that we've gone through some of the strategies, tips, and challenges of working remotely, how do you support your team through this crisis? First of all, we want to continue to support their training and development. Finding ways to improve your staff and virtual training. How about many training providers are offering truly discounted rates and free webinars. So do your research and see what you might be able to find available that's cost effective. I would also suggest topics specific to your industry or soft skills-based trainings, like leadership and supervisory skills. You can also engage employees by empowering them to lead a virtual training. What about timekeeping or computer skill-based trainings? Can a manager or supervisor research and provide a training on conflict resolution or providing feedback? There are a lot of different topics that are out here that your staff can learn and then teach others. Take advantage of this time. And finally, we need to support our staff emotionally. Establish daily check-ins with your team. Keep everyone in mind. It wouldn't hurt to make a list of your team members and include some pictures with them too. With this, you'll be able to make conscious decisions allocating responsibilities and information. They'll be right in front of you all day long. Set the tone for employees by being calm and positive. Try to lead by example. Encourage your employees to not get sucked in by the news. Right now, one of the biggest distractions is the news. It's good to stay informed, but the news will still be there after 5 o'clock. We're all aware that there are financial implications regarding this pandemic. The financial impact of the COVID-19 crisis is being felt globally across all industries. Some businesses are forced to close either temporarily or permanently. If you find yourself in that situation of having to lay off your staff, be direct and honest. If you don't plan to bring them back, please tell them so that they can move forward and do what's best for themselves and their families. Help them navigate their next steps, from filing an unemployment claim to embarking on a new job search in the middle of this unprecedented crisis. Thank you. We are now on to our second polling question.
Great. Thank you so much, Kim. Our second question is, how has your organization attempted to enrich the remote work experience for employees during this difficult time? Please take a moment to answer now. While participants are submitting their answers, I will provide our second CPE word. The second word is deadline. Again, if you wish to receive CPE credit, please jot this down, as it will be required for the survey at the end of the webinar. And again, that second word is deadline, D-E-A-D-L-I-N-E.
Great. And for, again, those organizations that have not attempted anything at this point, please just make a phone call. I think we all have our cell phones. Hear somebody's voice and share yours with them. And with that, I'm now going to turn it over to Troy Turner, who will be addressing individual tax matters.
Thank you, Kim. And thank you, everyone, for joining us this afternoon. I'm going to cover some individual tax issues that have been released recently, some benefits that everyone should be aware of. So we're going to start off with some of the low-hanging fruit here. You've probably heard some of these items, but I feel like you'll still get some information out of this. So first off, we'll start with the tax deadlines. So individual C Corp and trust tax returns that were originally due on April 15th are now due July 15th, and that includes any payment associated with filing those tax returns. At the state level, local jurisdictions, Maryland is following the same deadline as the feds, so they also have a July 15th filing deadline. Same with DC. Virginia has not changed their deadline. Their deadline's May 1st, but they do have an automatic extension of time to file your tax return without filing the extension form, as long as you don't owe them any money. They have extended the due date to make a payment from May 1st to June 1st without any sort of late payment penalty, but they are still charging interest if you choose to pay them June 1 rather than May 1st. So they've done the least out of our three local jurisdictions as far as relief goes. For 2020, estimated tax payments, your first quarter federal estimated tax payment, which is normally due April 15th, is now due July 15th. None of the other due dates for your remaining 2020 estimated tax payments have been changed at this point. So your second, third, and fourth quarter payments due June 15, September 15, and January 15 are all still due on those dates. Maryland has gone along with the feds as far as moving the first quarter estimate to July. DC has not. You also have additional time to file your gift tax return if you need to do that. gift tax returns are generally due April 15, but that due date has been pushed back to July 15. If you normally wait to make your IRA contribution until close to the April 15th deadline, so the general rules are that for an IRA contribution for the prior year, so in this case for 2019, the due date to make that contribution would be April 15th of 2020. But given that the filing date of the tax return has been moved to July 15, so is the time frame for making your 2019 IRA contribution. And the same is true for your health savings account contribution or your medical savings account contribution. Both of those would have been due by April 15th of 2020, but now they're due July 15th, 2020. So there are some benefits related to retirement plan withdrawals. So normally if you're below 59.5, you can't take money out of your retirement plan without paying a 10% penalty. So what they've done is you now can take up to $100,000 out of your eligible retirement plan, which includes your IRA accounts. So up to $100,000 during calendar year 2020. You can take that out early without paying the 10% early withdrawal penalty. Now, if that's money's coming out of a taxable account, then you will still pay income tax on that in 2020. You just won't pay the 10% early withdrawal penalty. As far as the income tax goes, the standard treatment on this is that on this $100,000 is that the tax spread is over 3 years. So if you, for example, took out $90,000, you would pick up $30,000 of income on your 2020 return, $30,000 on your 2021 return, and $30,000 on your 2022 return. Even though you took all the money in 2020, you can spread out the tax hit over 3 years, and that's the default. If you'd rather pay the tax all on your 2020 return, then you can elect to do that. If you just need these funds for a short-term loan of some kind, kind of bridge the gap here, then you are allowed to put this money back in to your retirement account within 3 years of the date you took it out. And then none of it would be considered taxable income. So under the normal rules for IRAs, you could take a distribution on your IRA and then put it back in within 60 days, and it would be considered just a rollover from one IRA to another, not taxable. This is a similar treatment, but instead of a 60-day time frame, you have a 3-year window to put the money back into your IRA if that's where you took it from, without paying any tax on the distribution. So this is a very good benefit for those that are having short-term cash flow issues and maybe could have used the money now. So in order to take advantage of this provision, the taxpayer, spouse, or dependent in the family must have been diagnosed with the SARS-CoV-2 or the COVID-19 virus, or more importantly, as far as qualification goes, have experienced financial hardship because of a quarantine, layoff, reduced hours. So I think a lot of people will fall in that latter category. Hopefully, very few of us will fall in the former. So I think a lot of people will be able to take advantage of this provision if they so chose. So you also, another benefit related to retirement plans is that for your current employer, you normally wouldn't be able to take money out of your 401k or 403b plan since you're actively participating in it. But those plans generally allow loans, and the cap historically on that, if the plan permitted loans, would have been $50,000, but they've increased that loan cap to $100,000, and you're allowed to take up to $100,000 as a loan out of your qualified employer plan within 180 days following the enactment of the CARE Act, which was enacted on March 27th. If you have a current existing employer, a loan from your employer plan, then you can delay repayment on that for a year. So there's a little bit of a break there for you on that. For those who are not looking to take money out of their retirement account and there is a benefit for you if you're subject to required minimum distributions under your retirement plan and don't need the funds and therefore would rather not take the money out while the stock market is currently down, then you're not required to take your RMD during 2020. So we now reached our third polling question.
Great, thank you, Troy. So please take a moment to answer our third polling question. Do you plan to utilize some of these retirement plan withdrawal provisions to help with personal or business cash flow needs? And while you're taking a moment to answer, I will provide the third CPE word, which is cash. Again, if you wish to receive CPE credit, please jot this word down. You will need it for the survey following the webinar. Once again, our third CPE word is cash, C-A-S-H. And in just a moment, when we have the answer to our poll, I will let Troy address the responses.
Okay, great. I was expecting a little higher percentage on the yes side, so that's really good news that people are in good shape and don't plan to take money out of their retirement account. So now we're going to cover some information on the recovery rebates. So I'm sure you've heard the news that the government wants to get money in people's hands. They understand that with all that's going on and disruptions in people's jobs, that having a little money immediately would be very useful for everyone. So they've come up with these recovery rebates. So basically, this is a 2020 tax benefit. But mechanically, they're going to send out the rebates, the qualifying amounts today based on prior tax filings. So an eligible individual can get up to $1,200, and on a married filing joint return, that would be $2,400, plus $500 per qualifying child, and a qualifying child is under the age of 17. An eligible individual is a person who has a U.S. Social Security number, is a U.S. citizen or resident alien, and is not eligible to be claimed as a dependent on another return. So it's not whether or not they claim themselves, it's whether or not they're eligible to be claimed as a dependent on someone else's return. So these are the only criteria. I know in the initial write-up of the law, there is some sort of an income amount, kind of a minimum income amount reportable on your return, but that was not part of the final law. So these are the only three criteria you need to pass in order to be eligible, in addition to some AGI limits. So not everyone will get this. So it's income specific. So if your income is above a base phase out level, depending on your filing status, then the amount of credit you qualify for will be reduced until eventually it goes down to zero. So the way the phase out works is there's a $5 reduction in the credit that you qualify for every $100 above the base phase out amount based on your filing status. So you'll see here, if you file single or married filing separate, the base phase out level is $75,000. And assuming a single filer with no dependents, your ability to get your $1,200 would completely phase out at an AGI of $99,000. For head of household filers, the base phase out amount, AGI phase out amount, is $112,500. And if you had a head of household with one child, so one dependent qualifying child, your ability to get that $1,700 credit would phase out completely at $146,500. Married filing jointly, the base phase out amount is $150,000. And if you assume married filing joint with no children, then between $150 and $198 you phase out, and at $198 above that you have no credit. So mechanically, what the IRS is going to do is, if you filed your 2019 return, so they're first going to look at your 2019 filing, look at your filing status and your AGI level, and then the number of dependents on your return, and figure out what type of credit you would get, and then they would get the money into your hands. If you haven't filed your 2019 return, then they're going to base this calculation on your 2018 filing. And for those who have no need to file, say if you're retired and are just living on Social Security and don't have to file a return, then there's a provision of law that says they're supposed to look at your Social Security income to base whether or not you get the credit. Now, if you don't file in 2018 and 2019, or if you don't qualify in 2018 and 2019 because of AGI limits, but you would in 2020, because this crisis has negatively impacted your income. So maybe you had AGI above the limits in 2018-19, but you are now below the AGI thresholds in 2020. Then when you file your 2020 return, you can claim the credit there, and it's a refundable credit. So one other item there is that if you use direct deposit on your 2018 or 2019 return, then the IRS is going to use that same banking information to directly deposit what they calculate your recovery rebate to be. And if you didn't do that, then they will most likely end up having to mail you a check, but they're also supposed to be setting up a website where you can put in banking information so that they can send you the amount electronically via direct deposit versus a check in the mail, because obviously that'd be the slowest method to get you the information. And the IRS is supposed to mail out everybody some sort of a letter stating the amount you're going to get and how it's coming to you. So some other provisions relate to charitable contributions. So historically, for those who have itemized and made charitable contributions, there has been a limit to the deduction of those charitable contributions, and it's generally been based on a percentage of your adjusted gross income. So for example, prior to this recent change, the percentage was 60% of your AGI. So if you had AGI of 100,000 and you wanted to make a one-time large gift to your alma mater or something for 100,000 that year, then your deduction would be limited to 60,000 under the old rules. But now there's no AGI limitation for 2020 cash donations. So it's just for 2020 and it's just cash donations. So in that example, if you had an AGI of 100,000 and wanted to give away 100,000, you could take the deduction on Schedule A for the full 100,000. For those of you who do not itemize, under the new tax law, the standard deduction is much higher than it used to be. So a lot more people take the standard deduction than itemized now. They've thrown a small benefit out there to encourage charitable giving for those folks, and you can take a $300 deduction on the front of your return, even though you're taking the standard deduction. So I'm now going to turn over the presentation to Walter Dial, who's going to cover some business items.
Thanks, Troy. That was great information. And much like the information that Troy just covered that talks about the individual provisions that were in the CARE Act, there's also a number of provisions aimed specifically at businesses to help them also survive the pandemic. The first of these is the creation of a refundable employee retention credit for distressed employers. And the way this works is employers who have been hurt by this virus will receive an employee retention credit equal to 50% of qualified wages with a cap of $10,000. So the most they could receive is $5,000 per employee. The important point about qualified wages is that it breaks the qualified wage definition between employers with greater than 100 full-time employees and those with less than that. If an employer has more than 100 full-time employees, they're going to get the credit for paying employees who are not providing services. For employers with less than 100 employees, they're going to get the credit whether the employees are providing services or not. And all this has to occur during the period when the business is considered to be distressed. And this is one of the few provisions that actually has a mathematical test to it. So the first part is just a basic test, as operations were fully or partially suspended due to shutdown orders related to COVID-19. Or, and then here's the mathematical test, gross receipts declined by more than 50% when compared to the same quarter in the prior year. So this is a credit that I think a number of employers should be able to take advantage of. One thing to keep in mind, and this is going to be true of pretty much all of the various payroll based benefits. If you're receiving small business loans to help you cover your payroll, then you're not going to be able to take advantage of these credits, or your advantage you can take is going to be limited. Another provision is the deferral of employer payroll taxes. And as many of you know, when you pay your employees, you withhold 6.2% for FICA up to the FICA limit. And then the company also contributes a matching 6.2%. Well, the matching 6.2% can be deferred. And what that basically means is that between now, or really the date of enactment, although it seems like April 1st seems to be the practical date for this. So wages from April 1st through December 31st, the employee match of the 6.2% can be deferred, meaning it does not need to be paid in. Instead, it's paid in the deferral period. The deferral amount is paid in 50% at December 31st, 2021, and then the final 50% is paid on December 31st, 2022. Some clients who are fairly small, they really don't want to fool around with the provision, and you can opt out of it. We're waiting to see exactly how the election to do it, whether it's going to be automatic or you opt out, or if you have to opt in. All that's kind of up in the air right now, and what the payroll forms are going to look like and things like that. But the major payroll companies sent out some announcements today, so it seems like they're starting to get their act together as far as putting this into place. But the bottom line is, you should not have to make those matching payments if you choose for the rest of the year, which could be a significant help to cash flow. As long as I've been CPA, which has been over 37 years, there's always been a net operating loss carryback. And what that basically means is, if your company loses money, you can take that loss and carry it back and recover taxes that you paid in prior years. As part of the Tax Cut and Jobs Act, which was enacted a couple of years ago, for the first time, they actually did away with the net operating loss carryback. And instead, if your company lost money, your only option was to carry that loss forward and to offset future income. But realizing that companies could use the cash, they have the CARES Act reinstates the net operating loss carryback period, and it gives it a 5-year carryback period. So any company who is going to report a loss this year on their 19 return or next year on their 20 return can carry those losses back 5 years. You go back 5 years and then 4, 3, 2, 1 until you've used it up, and you get a refund of all those taxes. The other interesting thing about this, if you'll see on the slide, that for your 2018 return, which presumably has already been filed, if that return had a loss, which you were carrying forward because that was your only option, you can now go back and take that loss and carry it back 5 years. So again, this is a provision to try to get some cash into the hands of businesses. Another provision, and this one we don't see a lot of, but you do tend to see it occasionally. And this again was a provision that was part of the Tax Cut and Jobs Act. And what the provision in that bill did was it limited a business to $250,000 for a non-corporate taxpayer, $500,000 in the case of a joint filer. So this would be for sole proprietor type clients. And so basically, if you had a loss that exceeded these limits, you couldn't deduct it. You had to carry it forward. So again, in an effort to try to let people take advantage of losses to generate more substantial refunds, this limitation has been temporarily suspended. So no matter the size of your loss on your 2019 return, you can go ahead and use it. They also have the credit for the prior year minimum tax liability. This again was part of the Tax Cut and Jobs Act. And basically the way it works, certain AMT credits that you were able to use. Really, it took you quite a while to use them. So they've changed the rules in an effort to accelerate the ability of companies to recover those credits. Another provision, you don't really see a lot of, but certain businesses, industries, the businesses have a lot of interest expense. So again, as part of the Tax Cut and Jobs Act, there was a limitation put in place that would allow you to only deduct interest up to 30% of your taxable income. So that has now been increased to 50% for 2019 and 20. And as like Troy mentioned, they modified the charitable deduction limits for individuals. They've done a similar thing for corporations. The way corporation charitable contributions have always traditionally worked is they could deduct an amount based on a 10% of their income limit. So for 2020, that's been increased to 25%. Certain businesses who have like food inventory that give to homeless shelters or food kitchens, that type of thing, they've always been allowed to deduct up to, they had a 15% income limit. That's now been increased to 25%. And then again, the Tax Cut and Jobs Act, when they passed that, they kind of messed up the depreciation for qualified improvement property. It was kind of a wording problem, but they were never able to pass a Technical Corrections Act and correct it. So they've taken advantage of this opportunity to correct that. So now a business who puts in place qualified improvement property, they can now treat that, as they should have been able to all along, as 15-year property, which enables them to write it off right away. With the drafting error in the previous legislation, they were forced to depreciate it using a straight line method over 39 years. That's really it for the corporate provisions. I'm going to turn it over to Dan Farrington, who's an employment law attorney and partner with Fisher Phillips. And Dan's going to discuss the employment law aspects of COVID-19 legislation.
Thanks, Walter. We work with employers of all sizes on the laws that govern the employer-employee relationship. And those laws have been a shifting landscape during the COVID-19 crisis. One of the most significant changes that we've seen has been the Families First Coronavirus Response Act, and in particular, that legislation's creation of emergency paid sick leave and expanded employee rights under the Family and Medical Leave Act. Both the emergency paid sick leave and the FMLA expansion became effective today, so this is a timely conversation, and they're set to sunset at the end of this year. The law applies to all employers with fewer than 500 employees, although there is an extremely narrow exception for businesses with fewer than 50 employees where providing certain types of leave would jeopardize the continued viability of the business. All employees who work for a covered employer are entitled to emergency paid sick leave for qualifying conditions. And that's true regardless of whether the individual is full or part-time, and regardless of how long the individual has been employed. With respect to the expanded FMLA, everyone working for a covered employer who has been employed for more than 30 days is eligible. There's a notice requirement. Covered employers have a legal obligation to distribute notice of these new rights to employees. For any employers on the call that have not distributed that notice yet, if you email me after the webinar, I'd be happy to send you a copy of the notice, as well as the Department of Labor's instructions on how to distribute the notice, given that so many people are working from home. My email address is dfarrington@fisherphillips.com, and it's on the question slide at the end of the webinar as well. Eligibility for emergency paid sick leave is limited to occasions when an employee is unable to work or telework because the employee is under a quarantine or isolation order. The employee's doctor has advised the employee to self-quarantine. The employee is experiencing COVID-19 symptoms and seeking a diagnosis. The employee is taking care of someone who meets any of those criteria, or the employee can't work due to childcare reasons because the employee's child's school or daycare is closed or their regular childcare provider is unavailable because of COVID-19 reasons. It's important to recognize that to qualify for emergency paid sick leave, the employee must be unable to work because of one of the reasons expressed on this slide. An employee who isn't working because the employer has closed or reduced hours due to a lack of business, and even those who are not working because employers are closed as a result of a government order to shut a non-essential business, are not eligible for emergency paid sick leave. All right, so if an employee is eligible for emergency paid sick leave, what do they get? Full-time employees are entitled to 80 hours of paid sick leave. Part-time employees are entitled to 2 weeks based on the average number of hours the employee has been scheduled to work. The rates of pay for emergency paid sick leave vary depending on the reason for leave. If the employee meets one of the first 3 conditions, in other words, they're ill or under a quarantine direction, they're entitled to their regular rate of pay up to a cap of $511 per day and a total of $5,110. If the employee is unable to work because they're taking care of someone else, either because that person is sick or under an isolation order or due to childcare reasons, the employee is entitled to 2/3 of the regular rate of pay, up to $200 per day and $2,000 in total. It's important to keep in mind that emergency paid sick leave is in addition to any other paid leave provided by company policy or state or local paid sick leave laws. This is an additional benefit for employees. If the rates of pay for emergency paid sick leave do not match the employee's full pay, either because they make more than $511 per day or they're being paid under one of the conditions that only pays 2/3 of the regular rate, the employee and the employer can agree to supplement with other company-provided paid leave, but that has to be by mutual agreement. The employee does not have a unilateral right to use additional paid leave to supplement, and the employer can't force the employee to use additional paid leave to supplement. But if everybody agrees, that's fine. Also effective today is an expansion of the Family and Medical Leave Act. It provides 12 weeks of job-protected leave for employees who can't work due to childcare reasons, identical actually to the emergency paid sick leave law, that being unable to work because the child's school is closed or daycare is closed or childcare provider is unavailable due to COVID-19 reasons. Many smaller employers that did not have to think about the FMLA before are affected by this expansion. Ordinarily, to be eligible for FMLA leave, an employee has to have 50 coworkers in a 75-mile radius and have worked for the employer for at least a year and have worked at least 1,250 hours in the 12 months preceding the leave. Under this expansion, however, any employee who works for an employer with fewer than 500 employees and has worked for at least 30 days is entitled to FMLA if they can't work due to those childcare reasons. Earlier versions of the legislation provided expanded FMLA for other reasons as well, but as the law that was passed is limited to absences occasioned by childcare needs. The first 10 days of expanded FMLA are unpaid, but employees may elect to use other paid leave, including the emergency paid sick leave that we just discussed. The next 10 weeks are paid at 2/3 the employee's regular rate, up to $200 a day and $10,000 in total. And in almost all circumstances, an employee will be entitled to his or her job back or to an equivalent job at the end of their FMLA leave. We're not going to get into these issues on today's webinar, but I want to highlight employment decisions around COVID-19 have to be made in consideration of a multitude of employment laws. We're talking to clients daily about payroll reduction strategies, such as layoffs and furloughs. Others are reducing hours and salaries, which can raise wage and hour questions. You want to be careful about the way you reduce an exempt employee's pay so you don't lose the exempt status when things return to normal. Any employer with more than 100 employees that's conducting furloughs or layoffs needs to be aware of the WARN Act. Obviously, we're seeing workplace safety and OSHA issues. Unionized workforces have additional labor law considerations. We're working with businesses through essential, non-essential designations. The Americans with Disabilities Act ordinarily prevents employee medical inquiries and examinations, but those rules are relaxed in light of the public health threat. That, of course, raises privacy considerations. And then finally, most of our clients have been interested in figuring out how to maintain health insurance for employees who they've had to furlough or whose hours have been reduced below the ordinary coverage eligibility. And so I highlight these issues just to encourage the employers on the call to make sure they're consulting with employment counsel on any COVID-19 related employment decisions they're making. So it's my pleasure to turn this over to Dick, who's going to talk about additional COVID-19 legislation.
Thank you, Dan. Got a lot of points to cover here on some of these next few slides. One of the things I want to impress on you all is that some of this information is still developing. I know you probably have sat in on some other webinars. You know, the Family First Act was signed, it seems like a long time ago, but not that long ago. And then, of course, we had the CARES Act that was signed less than a week ago. And some of the provisions are, as Dan mentioned, kicking in today. Some of the money we'll talk about will be available Friday. But there's a lot of information out there, and the challenge for us is to get through it and try and give you the best information that we can. And we're certainly going to do that, but just be aware that we have a website that on the COVID-19 response that we're continually updating with additional information. And I'll some of the information I'll tell you as we go through the next few minutes will bear some of that out. So the first slide, the Family First Coronavirus Response Act, as Dan mentioned, you know, there's in essence a burden imposed on some organizations that now have to pay, you know, paid sick leave and extended family medical leave, which usually FMLA can be unpaid. Now the good news in that is that there are offsetting tax credits that you'll see under Section 7001 and 7003 for both of those things that employers are required now to do, at least for the time frame, I believe through the end of the year, due to the coronavirus pandemic. So big picture things to keep in mind here. The credits are meant to fund the sick leave and emergency FMLA things that Dan covered. So in the situations where you're required to do it, if you meet those requirements for all those reasons, either under sick leave or emergency FMLA, there's a refundable payroll tax credit. Now this is great news for our clients that are exempt organizations, because a lot of times credits in the past under disaster things would be income tax credits, which obviously don't do them much good. It's an immediate dollar for dollar credit offset. And the employer can retain funds that otherwise are required to be deposited to the federal government for payroll taxes. And a couple of big points here. If the amounts retained are not sufficient, you can seek an expedited advance that the IRS is committed to, a streamlined claim. Form was, they mentioned last week, form was going to be released this week. I think it came out last night. We'll have the link up on our website soon. It's form, if we don't already, it's form 7200. So if your credit, the cost of you providing these sick or family medical leave benefits exceed the amount of payroll taxes that I'll get into in a second that you withheld, you can hang on to those and get a streamlined refund of the difference. And again, that's form 7200, and the form and instructions are now up on the IRS website. As I mentioned, I think they went up probably last night. So what are the payroll taxes that are included in the federal, that are included that you can retain? And there's a good question and answer thing that's also been updated. It's called the COVID-19 related tax credits for required paid leave for small and mid-sized businesses, FAQs. So what are the things that you can withhold and or retain? That includes federal income taxes withheld, the employee share of Social Security and Medicare, the employer's share of Social Security and Medicare with respect to all employees. So it's very generous in the sense that it can get you money. It can allow you to retain money that you would otherwise have to deposit in order to fund these benefits. So that's a great for those that have to provide these benefits. The government is basically funding it dollar for dollar up to those limits that Dan mentioned. Now, we did have a question that's saying, you know, what is the amount of the credit? And the amount of the credit is up to the $511 or $200 plus it's equal to the allocable qualified health plan expenses and the amount of the employer's share of Medicare imposed on those wages. So in addition to just the credit of what you're paying, it's also the allocable share of healthcare, and the law talks about being able to prorate it. There's no real guidance other than saying you can prorate it. Maybe it's the average cost of insurance premiums for everybody in the pool times the amount of, the amount of folks that qualify for this. But it's deemed, if you do this allocable, this pro rata allocation, that's deemed to be reasonable. And again, the Form 7200 will have some additional information on that. It also, I mentioned, includes the Medicare portion of the employer's share of Medicare is also part of that, in addition to the credit, the amount you paid. And the reason that it's just the Medicare portion is I believe that typically qualified sick pay is not subject to Social Security, but subject to Medicaid. So that's the reason that is singled out as being able to be retained, and in addition to the credit, as opposed to any Social Security piece of it. So going on to the another really important provision for a lot of our clients is the Paycheck Protection Program, the PPP. If you can avail yourself to this, it's generally available to small businesses, including C3s, with generally less than 500 employees. Now, I know that ASAE and some other organizations, C6s, are currently not able to avail themselves of this. That's our understanding currently. Now, this is phase 4. This is phase 3. The CARES Act is phase 3 of this funding in response to the coronavirus. There is a phase 4 and even a phase 5 discussions going on the Hill. And I know that ASE and some organizations are lobbying to make sure that C6s and other non-C3s may be able to avail themselves of the same protection. So for those of you that are C3s with C4s or C6s, keep your eye out on that as well. Loans will be made through local and national banks, not through the SBA. Even though I think it's being administered by the SBA, the banks, the lenders will actually be your local national banks, and will be available this Friday. So April 3rd is when they're starting to, I believe, able to process these loans, although we expect that it will take a couple of weeks. Some banks, if they're already an SBA 7A lender, are eligible right now. If they're an FDIC insured bank or credit union, Steve Mnuchin mentioned that he expects them to apply and to be granted the right to be able to administer these loans and give out these loans. We'll have there's some resources on the last couple of slides that I'll point out in a second. It's unclear whether or not the loan, which is based on the maximum of, or the lesser of, $10 million or 2.5 times average payroll. Now, I mentioned some of these things were changing, and Walter, who you heard from earlier, was on a call with an SBA person this morning, and they're thinking of changing that to 2 times payroll plus 25%. There is a link to a draft form of the SBA loan on our website on the COVID-19 response page, and that'll give you some idea of what the banks may be looking for. The interesting thing about the PPP loan is that it can convert to a grant for amounts spent during 8 weeks for payroll, rent, interest on mortgage, and utilities. So that's a really important part. If you can, again, avail yourself to this, that portion of it, and really it's meant to, keep businesses going for the next 2 months till we get through this crisis. Now, one question that often comes up is, will these funds run out? And I think it was about $389 billion was allocated, if I get that number right. And they didn't just pull it out of the air, believe it or not, but they actually came up with a number what they thought would be the payroll for 8 weeks, or an approximation of the payroll for 8 weeks for employers under 500 employees. So it is possible the funds could run out. Our advice to you is, if you think you can avail yourself to this, contact your bank, see if they are currently a loan certified lender, or if they plan to be, and make sure you start getting your paperwork together and work with them to see what they may need. As I mentioned, the draft form of this loan is on our website, and that'll give you a good idea, a good start. But start having those conversations now so that you can get in line. If the money does run out, Congress would have to reallocate, which we would expect they would do if it was needed, but there's no obviously guarantees, but we would expect that they would do that. Now, the next loan that's available is the SBA, what they call the EIDL loan, the Economic Injury Disaster Loan. And so on the next slide, you'll see that we have some qualifications there of, small businesses, fewer than 500 employees, and 501c organizations. Now, as I mentioned, this information is still developing. There's still some interpretation that's going on. The AICPA TRP, which I'm a chair of right now and a member, we had some internal discussion as to, are the 501Cs subject to the 500 employee limit? If you look at the SBA application, you can go online. It does not seem that the 501Cs, and that includes C3s, C4s, C6s, et cetera, are not subject to the 500 employee limit, but at least from the information we have now, so keep that in mind. The rate is 2.75% for nonprofits. Payments will be deferred up to a year, is what we're hearing. There is no personal guarantee for loans up to $200,000. You're approved on credit score, not your tax return. And this, as opposed to the PPP loan, is done through the SBA. Now, the important point here is that there's a $10,000 emergency grant that you can apply for, and the funds are supposed to be available within 3 days. And even if your application for the EIDL loan is rejected, you don't have to pay that back under any circumstances. My understanding is if you also get a PPP loan, that $10,000 is folded into that, so you can't double dip in that regard. And then just a point on the PPP loans. Again, these things are evolving, but from information that Walter provided early, and Walter, feel free to jump in and correct me if I misstated, is that they were thinking of a deferral for a year and then maybe 10 years payment. I think it's going to go to a deferral for 6 months and then a 2-year payback. But again, we'll keep our eye out on that and post information as we can. Now, the next 2 slides are just some resources on some things that I think would be helpful as you go through as we go through as this information develops. And with that, I think we have our next polling question.
Very good. Thank you, Dick. Our next polling question: is your organization planning on applying for a PPP loan? So please take just a moment to answer that question. And while the participants are submitting their answers, I will provide our 4th CPE word. The 4th word is credit. Again, if you want to receive CPE credit, please jot this word down because you will need it for the survey following the webinar. And again, the word is credit, C-R-E-D-I-T.
And so just
Dick,
a quick note, you see, yep, 43%. So as we surmise, we think that this would be a helpful tool for a lot of our clients. And the unsure part, hopefully, as things develop and after this webinar, you'll have an idea of whether or not you qualify and make a decision based on that. And with that, I'll turn it over to Ian.
All right, thank you so much. So what I wanted to do to wrap up the webinar today is to kind of share with you some of the conversations that I've been part of as clients have been navigating this, and then kind of show a little bit about how we as accountants can gather and present the information that informs those discussions. So if you think back really just a couple of weeks when all of this started, the first wave was everything started to get canceled, whether it was a gala event, ticket sales for concerts or plays, basketball games, whatever it was, if it involved the public and going outside, it went dark and it's not happening. That led to a whole wave of conversations about, well, should we cancel? Can we reschedule? Can we go virtual? Do we have to give refunds? How can we avoid giving refunds? Can we give credit to future events? Can we ask people to convert ticket sales into donations? All of that. All those conversations were happening. And I think that led fairly quickly to a recognition that this health crisis was really going to be a cash flow crisis for a lot of us. That led to kind of some what I'll call thought experiments to think about the impact on your company or organization by sort of turning it around and putting yourself in the shoes of your customers or funders or donors for all of your different revenue lines, to think about, well, how is this all going to affect them? And then indirectly and then directly, how is it going to affect you? Out of that was a lot of conversations about, well, maybe let's talk about using our cash reserves, if you have cash reserves, or borrowing from our line of credit. So the cash reserves, these are funds that nonprofits have spent. If you're lucky enough to have one of these, nonprofits work really hard to develop these reserves. And these are these rainy day funds. So there were a lot of discussions where people were reluctant to use them, but then we kind of got into these, well, let's be honest, it's a rainy day. So a lot of entities are looking at pulling into their reserves, which brings about conversations about, well, are those funds restricted? Are they designated by the board? What are the rules about whether you can tap into that? And then if you are tapping into that and liquidating investments, which investments did you want to liquidate? So that brought in investment advisors talking about their portfolios. I do want to talk about the line of credit. There maybe a couple of weeks ago, starting to have conversations about, well, kind of worried that banks might have a bit of a run on cash where companies start pulling money from their line of credit just to have it. And that might lead banks to start tightening the lending market. And I think a couple of weeks ago, that sounded a little bit hysterical, but fast forward a few weeks now, and what was hysterical and maybe silly a couple weeks ago really has become reality and maybe prudent. And we have seen this happen. We're seeing companies do this. We're hearing about it from banks. So maybe not a bad idea just to look at what you have available on your line of credit, pull it, knowing that you're going to pay interest on it for a little bit, calculate that cost, and just to have that cash available quickly in case something happens on the banking side. Also, a reminder to look at when those line of credits renew. If your line of credit is coming for renewal in the next, couple of months, your conversation with the bank about renewing it is likely to be very different than maybe you were thinking. And also for either of those, the reserves or the line of credit, think about what your administrative process is internally and what you can get in place now for these so that the funds are there. On the expense side, we've had a lot of conversations where you're really just looking line by line through the expenses. What do you have to pay? What can be delayed and what can be cut? And those are some tough discussions and difficult decisions, but that's kind of just looking for options on what you can do. So two things related to that I wanted to highlight. One is an old issue that comes up, which is the concept of fixed versus variable costs. A lot of costs are variable, and by that I mean they go up and down with some measures, with some other factor. So as your operations are getting shut down, or maybe your offices are closing, or events are getting canceled, there are some costs that just change on their own as a result of that. And so those are different than fixed costs, which, yeah, you've got some control over those, but essentially they're set maybe by some agreement. So the costs work differently. And as you're modeling this and thinking about what to do, it's good to be aware of that. Also, probably a good time to look at expenditure control. And this is just, if this is not business as usual, maybe you want to make decisions about spending a little higher up in the hierarchy. So I also wanted to look at two terms that come up a lot in these discussions, and I've even heard these on news stories on NPR, burn rate and cash runway. So burn rate, the definition of that is this is how much you spend in a generic month. So we're not looking at any specific month, just generically, your company spends X dollars. Your runway is a measure of your total cash divided by that burn rate, and that's expressed in the number of months. So it's basically how many months you can survive if no more cash comes in. Not that we don't think any more cash will come in. That's just the standard of how we measure this. And that's of course a fraction with burn rate as the denominator. So you can do different scenarios. If you come up with a lower burn rate, if you make different decisions, then that changes the calculation and can buy you more time. And then moving on, that's going to get to our last polling question.
Okay, thank you, Ian. Our last polling question is, how severely has the cash flow crisis affected your organization? So while participants are submitting their answers, I will provide our final CPE word, which is control. So again, please jot this word down. For the survey following the webinar, you will need it to get CPE credit. Once again, that final CPE word is control. C-O-N-T-R-O-L, control.
Okay, and here you can see why we're talking about this. So, a lot of people, at least in the moderately, so this is really impacting really everybody. So with all of that, we look at, well, what can we as accountants do to provide this information in a way that's useful to guide these conversations? And we often do that as a cash projection. So a projection here, we're saying at the end of March, so going into April, I have $122,000. From there, you've got two variables to look at, which are cash receipts, that's cash in, and expenses. Cash receipts, I just want to highlight that here we're looking at cash, not necessarily your revenue from your books. Those things can be different. So I don't want to get too hung up on the cash versus accrual distinction, but what you're looking for here is cash. In a normal world, or what used to be normal, expenses were maybe from your budget. And then we would just calculate out, starting at this number coming into April, what do we think cash receipts would be? What are we budgeting for an expense side? That gives you an ending cash and can roll to the next month. And we can go out as many months as we have data for, as far as we're comfortable. Drop a burn rate in there, and then I can say, well, given a burn rate of 60, then at the end of each of these months, what would my runway be? And I can look at that as a graph and put the orange in there, which is cash receipts, the gray is the expenses, and then I can drop a line that shows what I think the cash would be at the end of these periods, and then look for danger points. And here I see that May, you're ending with 0.4 of runway, meaning you're going to run out of cash in less than half a month. So that's a point that I'm worried about. From there, I can do different scenarios. So if we go to the next page, then the next page would be a scenario where I'm thinking about the revenue side and then changing the revenue numbers. Can we go to the next page? There you go. So here I'm just looking at cash receipts and thinking, well, what in this new reality, what might cash receipts be? And then how is that going to affect my ending cash? And I can see that May is much tighter and June would go negative. And that might prompt me to think about what I can do on the expense side, which would be on the next page, where expenses I'm modeling down to a reduced level of 30,000 something to get a little more cash, and then just seeing what the effect of that would be. And I can see it visually in kind of in a way that's easy to see, easy to digest, and easy to model in a lot of different scenarios, just trying to inform these discussions. So thank you very much.
Great, thank you so much, Ian, and thank you everyone for participating. We do have a few questions that have come in. If you have a question for one of our presenters, please go ahead and enter it into the chat box on the screen. And I will start with a couple of questions that have already come in. First one I believe is for you, Dan. Can employees utilize the family leave benefit on a 1-day-a-week basis if they are assisting their children with their schooling? For instance, take off every Friday to help their children with school and not have to use their vacation time.
If the employee is unable to work and telework for that 1 day a week, they would be entitled to the expanded family and medical leave. If it's merely a preference to take the day off to help with homework, then that would not be a qualifying reason. The Department of Labor is encouraging employers and employees to collaborate with one another on these sorts of things and to be flexible. So I would encourage a conversation around what the need is and whether it prevents the employee from working, and if maybe the employee's shift could be adjusted as a result. So one other idea other than leave would be to have the employee work a partial day, or have the employee just work shift their hours later into the day. But that's a conversation to have with between employer and employee.
Okay, excellent. Thank you. Another question from the same individual. If you apply for the $10,000 EIDL advance, is that put towards your loan amount? Will that $10,000 be forgiven regardless of if you're approved for an EIDL loan or not? Dick, do you want to take that one?
Sure. My understanding is if you're applying for an EIDL loan as opposed to a PPP loan, that doesn't have to be repaid under any circumstances. If you also get a PPP loan, then my understanding is that gets folded into the amount that you would qualify for. But could ultimately, I would assume if it gets folded in there and there's a portion of your PPP loan that gets forgiven, that could be part of that to the extent it was paid for the appropriate costs of payroll, rent, interest, utilities, etc.
Okay, thank you. Let's take another question. Walter or Troy, this one might be for one of you. How does a professional service firm partner-owned LLC qualify for the payroll protection aspect of the CARES bill? If partner draws are simply firm profits, how far does partner pay have to drop in order to claim difficulty in meeting payroll? Or is eligibility determined based on percentage of lost revenues or lost income?
Well, there aren't really any, mathematical tests like that. It's just a matter of whether or not your business was impacted by COVID-19. I think most businesses will be. So assuming there's a drop in revenue, then they would qualify presumably for, if they took out the Paycheck Protection Loan and they maintain their employees, or if it's just the partners, maintain the partners, they would qualify for the forgiveness piece. The wages for this purpose would be capped at $100,000 per partner, and that would be, prorated over the year. So that would be the limit on what they can be forgiven, plus, some allocable rent and things like that. I think that's the question that they're asking. It's a little hard to follow.
Okay, and if anyone on the webinar, if you need more information, if we didn't answer the question completely, or if you need further clarification, of course, by all means, feel free to reach out to any of the presenters directly. One more question. I've read lots of guidance on the new act, but I'm getting confusing information on how the employer Social Security tax should be handled. Is it considered and reported as a payroll tax credit, or should it not be taxed for employer Social Security at all? I've seen the handling of the employer Social Security taxes being handled separately than the employer Medicare tax. Medicare tax for the employer being handled as a payroll tax credit. I think we covered that, but can you clarify on that, one of our tax presenters?
Yeah, I'm not, again, a little hard to follow the question, but if they're talking about the deferral of payroll taxes, you simply don't pay in the 6.2% FICA. They might be talking about the credit that Dick addressed, because I think there was more confusion regarding that credit than there was regarding the payroll deferral.
Dick, do you want to address that some more?
Yeah, so Walter, just to kind of recap, the 6.2%, you're talking about the deferral of the deposits for just employers in general. The credits that we were talking about that Dan mentioned about, for sick or for emergency family medical leave, to the extent you apply those wages, and this is information that I think was added to the website yesterday, so it's still relatively new, but my understanding is that those wages are not subject to Social Security if they're sick pay or emergency family medical leave. They're subject to the employer's portion of Medicare. So your credit, in addition to the $511 or $200 that you paid, includes your allocable share of health insurance, pro rata, coming up with a calculation on employees that were affected, plus the employer's share, what the employer was out of pocket for having to pay Medicare on that. So the reason I think there's a divergence there is because of the FICA treatment of sick pay wages subject to Medicare, not subject to Social Security. That's my understanding. And I think there's some examples and some information on the website that we talked about. So hopefully that answers it.
Okay, very good. Thank you. I don't think we have any other questions that have come in. Any other panelists see any questions that you've received?
Yeah, this is Dan.
Okay.
I got one on. I got one about whether a furloughed employee can be eligible for unemployment benefits. And the answer to that is yes. Both furloughed employees and employees whose hours have been reduced, they would be entitled to partial benefits, and those applications are available online.
Okay, excellent.
And Jackie, this is Troy. I do have one question I see that related to the recovery rebate, whether or not someone gets an advance payment of a credit and then they do their 2020 return and say their income's higher and they wouldn't be eligible when they're calculate the credit in 2020. Would they have to pay any of that credit back? The answer is no.
Okay, looks like we do have one more question. Does the CARES Act address anything about employees teleworking in a different state? For example, your office is located in Virginia, but the employee works from home in DC. Who would like to take that one?
I'm not aware that it I'm not aware that it does. I think that may get into I know Dan had mentioned a provision that said if you have an employer with an employee within X number of miles, but I don't think that there's anything specific about teleworking in different states. I haven't come across anything anyways.
Yeah, this is Dan. I'm not sure I fully understand the question. The only thing I could think of would be whether the temporary relocation of the workplace to another state would implicate another state's paid or local sick leave laws. It's an interesting question. It's not one I've been asked before, so I haven't looked into it. But I'm not sure I fully understood the question as asked.
Okay, so whoever that question came from, if you'd like to contact Dan directly, he can hopefully help further with that, finding the answer to that question. And I do have a couple of other questions. It looks like if you work 6 hours per day instead of 8 due to children being home, are you entitled to leave under the extended FMLA or EPSLA? Dan?
This is Dan again. Yes, you're entitled to leave to the extent that you're unable to work as a result of one of the qualifying conditions. So in that case, the employee would be entitled to intermittent leave.
Okay, and then we have a question about the PPP average payroll calculation. Can you use the 12-month rolling, assuming using April 1st, 2020 versus 12 months in 2019? Walter or Troy, would you like to address that?
This was regarding the Paycheck Protection Loan, right?
I'm not certain. It says for the PPP average payroll calculation. Yes, so for the payroll protection program.
I don't know the answer to that. I'm not 100% sure that they've clarified it yet. So I'm sorry, I can't give a good answer to that.
Walter, I think from what I'm seeing, there's, if you don't have seasonal employees, so I think they're talking about how do you calculate your average monthly payroll to determine your maximum amount of loan. And as you mentioned, Walter, there's some things that are still developing. But my understanding is the way it's phrased currently is it's the average monthly payroll costs incurred during the year prior to the loan date. So, or if it's seasonal, you could use the average monthly payroll incurred for January and February 2020. If you weren't operational in 19, I'm sorry. And then if you're seasonal, it would be the average monthly payroll for 12 weeks beginning February 15th or March 1st, decided by the loan recipient and ending on June 30th. So if you're not a seasonal employer, I think you're using your average monthly payroll incurred during the year prior to the loan date. So
Yeah, I think that's right.
Okay. One other question regarding the EIDL loan qualification. It was mentioned that the loan will be approved using credit scores. Is there a minimum credit score needed?
The short answer is yes.
that's it.
I can't.
We don't know what it is.
The SBA website has it right on there.
Okay, so there is a minimum credit score that should be on the SBA website.
Right.
Okay, got it. And looks like we have another question. It says, since you can't do both, what are the benefits of applying for the EIDL over the PPP? My understanding was you can do both. Yeah, Dick, do you want to address that?
You can, and there's a lot of these provisions that we may not have gotten into in as much detail as we'd like because of time limits, but there are provisions where you can't double dip, so to speak. So if you got an EIDL loan, you can't get an EIDL loan for the same expenses that you're getting a PPP loan for. Also, you can't get forgiveness for wages under the PPP loan, I believe, if you are taking a tax credit for those, like if you get a tax credit for those things. So there are some provisions that prevent you from double dipping, but in general, you can get both if you qualify under both, but not for the same thing, is the short answer.
Okay.
Jackie, this is Ian. If I can add one quick thing on the payroll period question. I just wanted to add that I'm told by a colleague that banks are tying that information into the 941s, to payroll filings, which are quarterly. And so that, and I was told that the Treasury application from yesterday specified that as long as the company has been in business for that period and is not seasonal, that it should be 19. So that's I think the default, at least as of yesterday.
Okay, thank you, Ian. Very helpful. Okay. Any other questions?
Jackie, this is Dick. I just had one comment on Ian's important point there is, and I think I briefly mentioned this, but there is an issue as to whether or not C3s and C4s that may have the C4 as the payroll provider, and how we allocate who qualifies, because they may have a shared allocation agreement, and the C4 or the C6 may do the payroll, and the C3 may have employees that their time gets allocated. And I know through the we're seeking guidance on that. We know that it's an issue, but just to keep that in mind.
That is a good point, Dick. Another question that came in, if you have less employees now than in the first 2 months of 2020 because employees have left for other employment, how will this affect your full-time employee ratio for repaying any portion of the PPP loan?
This is Dick. My understanding is that you can hire them back. In order to avoid that, if you've had a reduction due to this, you can avoid the reduction in loan forgiveness if you hire them back and retain them through, I think it's June 30th. There is some provision there where you can bring them back on payroll and not get dinged for the fact that you know, before all these things were enacted, that you had to let them go.
Okay, thank you. Hold on, looks like I have one more. Looks like we might have answered that one already. Any other questions that the presenters are seeing? I think that's it. Okay. Well, I would really like to thank all of our participants who've attended today. I hope this was very helpful. And once again, thank you to our presenters as well. We have a couple more webinars coming up in April, which is on this last slide here. We encourage you to take advantage of those webinars. And again, on the slides, we do have the contact information for our presenters. So if there are additional questions or anything that you need clarifications or guidance on, please do not hesitate to reach out to any one of us, and we will see what we can do to get you help during this extremely challenging time. And everyone, hang in there and enjoy the rest of your day. Thank you.